Hey guys, hope you are all having a fantastic day. On my last video, we talked about AMC in depth. On this one, I am going to talk about the overall state of the markets and the economy, because the developments that are coming to light point to a much grimmer outlook than we previously imagined. Before we start, I want to quickly invite everyone into my Discord. We have been trading SPY and been making nasty profits these past couple of days. You can look and see these alerts for yourselves. Drop by the Discord, let me know if you are interested in trading and come make money with us. New revelations by the Fed officials as well as updated economic data foreshadow serious economic pains to come, and you need to be aware of everything that is going to happen. Let's start with the most important news, which I will be citing New York Times, which is the source I used. According to the Federal Reserve, officials are worried big time that inflation will remain uncomfortably fast. Some policymakers are fretting that financial markets will incorrectly interpret their decision to raise interest rates more slowly as a sign that they are giving up the fight against inflation. Inflation, as we have seen in the last couple of CPI reports, has begun to slow down, but still remains extremely high, and more importantly, it remains quick. The Personal Consumption Expenditures Price Index climbed 5.5% in the year through November to nearly triple the Fed's 2% inflation goal. Though the markets cheered during the last meeting, Fed officials still see inflation as unacceptably high and are worried that rapid price gains will have a staying power. The risks to the inflation outlook remain tilted to the upside, warned Fed officials during their December policy meeting. Participants cited the possibility that price pressures could prove to be more persistent than anticipated due to the labor market staying tight for longer than anticipated. Such risks set up a challenging year for the Fed policymakers, who will need to decide how much more they need to raise interest rates to bring inflation under control. The Fed apparently wants to avoid pulling back too early, which could allow inflation to become entrenched in the economy, but officials are also conscious that high rates come at an expensive cost. As they slow growth and weaken the labor market, workers are likely to earn less and may even lose their jobs. This is the reason the Fed wants to tread carefully, bringing price increases under control without inflicting more damage than necessary. Fed minutes said that participants concurred that the committee had made significant progress over the past year in moving toward a sufficiently restrictive stance of monetary policy, but more rate moves were judged to be needed and no officials expected to cut rates in 2023. This is huge. Let me repeat it again: no officials expect to cut rates in 2023. Participants generally observed that a restrictive policy stance would need to be maintained until the incoming data provided confidence that inflation was on a sustained downward path to 2%, which was likely to take some time, the minutes said. Fed officials emphasized the importance of retaining flexibility and optionality, which means they want to have wiggle room to change their stance abruptly if the need may come. Again, remember this, because we are going to circle back to it later on. Policymakers are also worried that markets might misinterpret their decision to slow the pace of rate moves, seeing it as a sign of a weakening of the committee's resolve to achieve its price stability goal, or a judgment that inflation was already making enough progress in slowing down. Policy works through financial markets, and if market-based rates dip or stock prices soar, that can make it cheaper and easier to borrow. So this was essentially the gist of what came out today, and though it was fairly easy to understand, I still want to touch on the most important parts because they highlight what is to come, so that you aren't surprised when markets move the way they will. First and foremost, these Fed minutes were more bearish than anticipated. In fact, unless all I read was wrong, these Fed minutes speak volumes of uncertainty in the Fed right now. We have said time and again that the best predictor of bullish market behavior is market certainty. That is, even if the news we receive are bad, having a broad and clear understanding of what is to come will alone maintain prices up and stable. Good news and even bad news, so long as all the pieces and moves are clear, the many gears in the machine of the global economy will continue working harmoniously. It is only when we start hearing narratives changing quickly, or big market players making erratic changes, that we begin to see major drawbacks and performances in the markets get bearish. If it wasn't clear enough, Fed officials literally said they see high rates for some time ahead and that they want to remain flexible in the event they need to change things immediately. As such, the decisions they are making are with the prioritization that they can be quickly changed and morphed so as to respond to the sudden quickness of inflation, market behavior and other economic variables. Though this is a very good and smart decision by the Fed, which I highly applaud, it is not nearly by any margin of the imagination bullish. It is saying in plainsman's words that hey, We can change our minds about any and all decisions we announce at the whim of a moment if we deem it so. This does not provide stability, which in turn does not guarantee investors and markets the confidence needed to buy, much less hold. They were cautioning the public that we should not be reading too much into the rate-setting Federal Open Market Committee's move to step down the pace of increased rates. This is monumental, because it goes into something we have been saying for over a year. Markets get any indicator of relative progress and all of a sudden they believe that everything needs to rally and go to the moon. CPI reports are treated almost as catalysts to catapult indexes into the stratosphere or down the pits of hell. This is not right, and the Fed is saying that they do not like how bullish the market and investors are getting at small economic improvements, because the reaction is way out of proportion. Sure, a lower CPI is better than a higher one. That does not mean in any way, shape or form that things are bound to quickly begin to be resolved and to expect new market highs in the coming months. It means that prices should remain stable. Now, here's my though. The Fed minutes talked about how we are reading too much into rate settings, while simultaneously announcing that the way they are doing things leaves them open to making changes at any given time without warning. This means, in layman's terms, that if the Fed sees a market rally that is inconsistent with how they believe markets need to behave, they will quickly move to make changes, including raising rates if necessary, to quell down the bulls. Again, this is an amazing move by the Fed which I stand by 100%, but it is one that should not lead to market rallies. Once again, price stability is everything, and right now if I had to summarize this Fed's meeting, I would say that the main theme here is that there is no stability and that there is no chance the Fed will not interfere directly to ensure markets begin acting right. Not a single member in the meeting expected rate cuts in 2023, despite the market's pricing. Current market pricing indicate they expect a likelihood of rate increases totaling 0.5 to 0.75 percentage points before pausing to evaluate the impact the hikes are having on the economy. They are also pricing the likelihood and possibility of a small reduction in rate by the end of the year. Fed officials are at odds with two-pronged policy risks. One is that the Fed doesn't keep rates high long enough and allow inflation to fester, and the other is that the Fed keeps restrictive policy in place too long and slows the economy too much, potentially placing the largest burdens on the most vulnerable groups of the population. More so, members said they saw the risks more weighted to easing too soon and allowing inflation to run rampant. Since my last video, a whole bunch of news have come out that show Americans are being to experience the real effects of this economic landscape. Latest research suggests that the share of adults ages 18 and 29 are living with their parents because they cannot afford rent. This, of course, has helped boost up profits for luxury good companies, according to Morgan Stanley, but it paints a striking image of how unaffordable mortgages and real estate have become. CNBC reported that the share of new car buyers with a monthly payment of more than $1,000 hit a new record high. We talk a lot about the housing market. New data showed that mortgage demand in the U.S. rounded out a rough 2022 with a double-digit weekly slump as borrowing rates for homes proceeded to re-accelerate. Applications for mortgages fell by 13.2% in the week that ended on December 30th from 2 weeks prior, hitting their lowest since 1996. Refinancing demand fell 16.3% from 2 weeks prior and was also lower by 87% than the same week 1 year ago. The readings came as the key rate for home loans started to push higher, reversing course from a recent downward slope. When I looked deeper into this issue, I was shocked to learn that the 2022 Housing Affordability Survey said that 55% of U.S. homeowners could not raise funds to purchase their home at current prices and interest rates. In simpler words, most Americans can't afford to buy their own home in today's market. One of the things that the corporate media has been pushing is an unfounded claim that Americans don't want to own housing, and instead want to rent forever. This same survey said that 86% of Americans still prefer to own rather than rent, which contrasts what the corporate media has been pushing for years now in order to change American perception of wealth. According to the State of Personal Finance in America 2022, a recent study showed that 36% of all Americans have absolutely no savings at all. Another 19% have less than $1,000 saved and only 45% have more than $1,000 saved. Inflation is literally eating everything away. Sure, we can definitely question the financial responsibility of many Americans and how they love going shopping, but when the number of people that don't even have $1,000 saved is larger than literally half the American population, when it wasn't like this before 2020, something is clearly amiss. Something even more interesting is that restaurants have reported growing sales, which the corporate media quickly used as evidence to suggest the economy is still well. However, what wasn't shown was that more sales don't mean more customers. In fact, industry watchers noticed that foot traffic to restaurants has been falling in recent months because inflation is deeply eating into budgets. There is this dichotomy where you see solid sales numbers, but at the end of the day, it's mostly because of price increases. Restaurants are being to outprice their own customers, and this can be quite dangerous in large numbers if this trend continues. They need to find ways to bring people back in because the longer this trend continues, the more unstable it will become. Recent reports suggest further major layoffs coming soon for big tech and the financial sector as well. Overall, the whole economy is tapped out. It will be interesting to see how companies hold out in the next batch of quarterly earnings. The Fed's statements were incredibly pessimistic and foreshadow a messy market for pretty much the rest of the year. If you think markets are going to start booming and recovering in a perfect uptrend, think again. As the Fed clarified today, the pains of rate hikes come about 1 year or so after they are first implemented, so this is when we are going to start feeling out economic pains all around. The Fed itself is uncertain and seeming quite cautious and not confident about how things will pan out, more so than in the last couple of meetings. I have another AMC video in the making right now. It will be regarding a hypothetical acquisition. My last AMC video is by far my most controversial, but I appreciate all the viewers who watched, disagreed and didn't resort to get toxic in the comments. I want theaters to boom. I wanted AMC to perform well, and I just think it has plenty of room to continue falling even post-split reverse. I highly recommend you guys join my Discord. We have tons of content there. We have been killing it these past couple of days with massive trades that have earned out members thousands of dollars. I will post screenshots here so you can see. Come by and let me know you are interested in trading so I can give you access. Thank you for your time. I hope to see you on the next video. Join my Discord and let me know what you thought of this video here on YouTube down in the comments below. To the moon.